EPK Capital presents Deep Dive on NTPC Ltd. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host, Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about NTPC Ltd. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. Imagine a single company responsible for lighting up every fourth bulb in a nation of 1.4 billion people. That company is NTPC, India's largest power generator and a cornerstone of its economy. But NTPC is more than just a utility company. It holds the prestigious Maharatna status, a title conferred by the government of India only upon a select few public sector giants, signifying its immense scale and strategic importance. Today, NTPC stands at a crossroads. It's a stable, dividend-paying behemoth, but it's also embarking on one of the world's most ambitious green energy transitions. So, is this a dependable utility stock for conservative investors, a future-facing growth story, or a potential value trap? In this video, we will conduct a neutral 360-degree analysis to help you decide. We'll examine the company's business model, dive deep into a decade of its financial performance, analyze its stock chart, calculate its value using Benjamin Graham's classic formula, weigh the pros and cons, and run some final checks before reaching a conclusion. The company and its promoter's business model. The core engine AI avatar. To understand NTPC, we first need to look at its core business. Founded in 1975, its primary function has always been the generation and sale of bulk electricity to state electricity boards across India. The scale of its operations is staggering. With an installed capacity of over 80 GW, NTPC contributes to roughly 25% of India's entire power generation. Its current portfolio is a mix of old and new. It operates 24 coal-fired stations, 7 based on gas or liquid fuel, 2 hydro plants, a wind farm, and 11 solar projects, in addition to several joint ventures. This diverse but fossil fuel-heavy mix is a critical point we'll return to. Beyond just selling power, NTPC has diversified its revenue streams. It runs a successful consultancy wing, engages in energy trading, explores for oil and gas, and even mines its own coal through a subsidiary, NTPC Mining Ltd., which helps secure its fuel supply. Strategic vision, the pivot to green AI avatar. While thermal power is its legacy and primary cash cow, the company's future is being defined by a massive strategic pivot towards green energy. NTPC has laid out an ambitious roadmap. The company targets expanding its total capacity to 130 GW by 2032. Some analysts even report an increased guidance of 149 GW. The most crucial part of this plan is the goal of achieving 60 GW of renewable capacity within the same time frame. To fund this transformation, NTPC has earmarked a colossal capital expenditure of approximately Rs 7 lakh crore by 2032. This isn't just about solar and wind. The company is actively developing projects in new-age areas like green hydrogen, waste-to-energy, battery storage, and even nuclear energy, signaling a comprehensive, forward-looking strategy. This strategic shift is fundamental. NTPC is effectively operating two distinct businesses in parallel. First, there's the legacy thermal business, a high-cash flow, low-growth engine. Second, there's the emerging green business, a high-growth, high-capex venture with potentially lower margins. For an investor, this means you are not just buying a stable utility anymore. You are underwriting a massive, long-term, and potentially risky corporate transformation. The success of this pivot will likely define the stock's long-term trajectory far more than its current operational efficiency. Promoters and shareholding structure AI avatar. So, who owns this behemoth? The primary promoter of NTPC is the President of India, meaning the government of India, which holds a controlling 51.10% stake. This sovereign backing provides immense stability and implicit support, but it can also bring the bureaucratic pace and regulatory complexities often associated with public sector undertakings. However, the government is not the only major player. A look at the shareholding pattern reveals significant confidence from professional investors. Key management. At the helm is a stable and experienced leadership team, as one would expect from a Maharatna PSU. The company is led by Chairman and Managing Director Shri Gurdeep Singh, supported by a board of directors overseeing key areas like finance, fuel, and operations. A decade under the microscope, 10-year financial analysis. Now, let's crunch the numbers. A look at the last decade of financial performance reveals a complex story about NTPC's health. Net profit and earnings per share have shown a steady upward trend. However, multiple sources flag a key concern. The company has delivered relatively poor sales growth over the past 5 years at around 11.4%. This raises a question. If core sales growth is sluggish, what's driving the consistent rise in profits? The answer lies in a combination of factors, including efficient financial management, contributions from other income, and a specific accounting practice. Financial reports have noted that the company might be capitalizing its interest costs. In simple terms, this means that instead of recording all interest payments as an expense against profits, a portion is added to the value of assets under construction. This can make current profits appear higher, but it increases the asset's cost, which leads to higher depreciation charges in the future. This suggests the quality of profit growth may not be as robust as the headline numbers suggest, and it helps explain the market's cautious valuation of the stock despite rising profits. Margins and efficiency. AI avatar. For a capital-intensive business like power generation, efficiency is key. Two important metrics here are return on equity, ROE, and return on capital employed, ROCE. NTPC's ROE over the last 3 years has been low, at around 12.4%. This means for every Rs 100 of shareholder equity, the company generates about Rs 12.4 in net profit, a modest return. Similarly, its ROCE stands at 9.95%, indicating moderate efficiency in using its massive base of assets and debt to generate profits. Balance sheet health. The debt question. NTPC operates in a sector that requires massive capital, and this is reflected in its balance sheet. The company carries a significant amount of debt, totaling approximately R250 trillion. This results in a debt-to-equity ratio of around 1.35. While high debt is common for utility companies, it remains a key risk factor to monitor, especially as NTPC embarks on its R7 lakh crore expansion plan, which will likely require even more borrowing. Charting the course, stock, technical analysis, AI. Avatar. Let's turn to the stock charts to see what the market sentiment is. While fundamentals tell us about the company's health, technicals tell us about supply and demand for the stock itself. Long-term perspective. Looking at the long-term chart, we can see that after years of trading in a range, NTPC's stock has delivered impressive returns over the last 3 years, rising over 115%. This provides important context for the more recent cautious price action. Current technical setup, medium term, AI avatar. Zooming in on the medium term, the picture is less bullish. The stock is currently in what technical analysts call a falling trend channel, meaning it has been making a series of lower highs and lower lows, indicating persistent selling pressure. More recently, the price has been consolidating within a rectangle formation, trading sideways between a support level at approximately Rs330 and a resistance level at R342. This indicates a period of market indecision. A decisive move above Rs342 would be a positive sign, while a break below Rs330 could signal further weakness. Key indicators and signals. Let's look at a few key indicators. Moving averages. The stock is currently trading very close to its 50-day and 200-day moving averages. Recent price action has seen it dip below these key levels, which is often interpreted as a bearish or sell signal. Momentum. The Relative Strength Index, or RSI, is hovering around 51, which is considered neutral territory. This confirms the lack of strong buying or selling momentum and supports the idea that the stock is in a consolidation phase. Volume. Perhaps the most telling indicator is the volume. There appears to be a negative correlation between price and volume. In simple terms, when the stock's price rises, trading volume tends to be low, but when the price falls, volume is high. This is a classic sign of weakness, suggesting there is more conviction and enthusiasm among sellers than among buyers. This creates a fascinating divergence. On one hand, fundamental analysts are overwhelmingly positive about the company's long-term story. On the other hand, the technical chart, which reflects the market's day-to-day actions, is signaling caution and weakness. It suggests that while analysts are buying into the future green energy narrative, the market is taking a wait-and-see approach, demanding more proof before pushing the stock higher. The Value Investing Benchmark, Benjamin Graham, Valuation. To get a conservative estimate of the stock's intrinsic value, we can use a formula developed by the father of value investing, Benjamin Graham. The Graham number gives us the theoretical maximum price a defensive investor should pay for a stock. The formula is the square root of 22.5 multiplied by the trailing 12 months earnings per share, EPS, and the book value per share, BVPS. The formula is Graham number 22.5 SEP x BVPS. Using the latest available data, TTM EPS is Rs2471.17, BVPS is R18985.17. Plugging these in, we get 22.5's 24711189, 85 Rs 324.85. The Verdict AI Avatar. The calculated Graham number for NTPC is approximately R325. With the stock currently trading around R333, it is priced slightly above its Graham number. According to this strict, conservative valuation model, the stock is fully valued and does not offer a margin of safety at the current price. This is an important check. While many point to NTPC's low price-to-earnings (PE) ratio of around 13.6 as a sign of it being cheap, especially compared to the broader market, the Graham valuation offers a different perspective. It suggests that the low PE isn't necessarily a sign of undervaluation, but rather a fair reflection of the company's modest return on equity, high debt, and the inherent risks in its business. The stock isn't being offered at a discount to its tangible fundamentals. The investment thesis, pros versus cons. So, let's bring it all together. Here is a summary of the bull and bear cases for NTPC. The bull case, strengths and opportunities. Market dominance. NTPC is the undisputed leader in India's power sector, making it indispensable for the country's energy security and economic growth. Clear growth. Pivot. The company has a well-defined, massive plan for expanding into renewable energy, green hydrogen, and nuclear power, offering a clear growth runway for the future. Sovereign backing. Being majority-owned by the Government of India provides a strong safety net, minimizing bankruptcy risk and ensuring policy support. Consistent shareholder rewards. NTPC has a strong track record of paying dividends with a healthy payout ratio of 37 to 41%, making it an attractive option for income-focused investors. Strong analyst consensus. The stock is overwhelmingly rated as a buy or strong buy by market analysts, who see significant upside potential from current levels. The bear case, weaknesses and threats. Weak financial metrics. The company suffers from historically poor sales growth and a low return on equity, which points to inefficient use of its capital base. High leverage. It carries a massive debt load that is expected to grow as it funds its ambitious CapEx plan. This poses a significant risk to future profitability and financial flexibility. Major execution risk. A R7 lack crore capital expenditure plan is monumental. The company faces substantial risks of project delays, cost overruns, and integration challenges that are common in the infrastructure sector. Significant ESG concerns. NTPC's history is marked by serious environmental and social controversies. These include allegations of forced land acquisition, violent protests like the Barcagayon police firing, environmental pollution from fly ash and contaminated water, and a poor worker safety record, highlighted by the tragic Anchahar boiler explosion. These are not just past events. They represent ongoing operational and reputational risks that could impact future projects and investor sentiment. PSU inefficiencies. As a public sector undertaking, NTPC is susceptible to bureaucratic delays, and its profitability is dependent on tariff structures set by government regulators. Final due diligence, important checks. Before we conclude, let's run a few final checks that are crucial for any investor. Promoter pledging. The promoter, the Government of India, has 0% of its shares pledged. This is a strong positive, indicating no financial distress at the promoter level. Credit rating. The company holds strong credit ratings, such as CRISIL A stable, which signifies a very high degree of safety regarding its ability to meet financial obligations. This strong rating helps mitigate some of the risks associated with its high debt. Institutional ownership. Finally, as mentioned earlier, the high ownership by foreign 16.09% and domestic 28.92% institutions shows that many large professional investors have conviction in the company's long-term story. Conclusion and disclaimer. So, what's the final verdict on NTPC? The analysis reveals that NTPC is a story of two companies in one. On one hand, you have a stable, government-backed utility with a dominant market position and a consistent dividend stream. On the other, you have a high-debt, capital-intensive giant undertaking a monumental and risky pivot to green energy, all while carrying significant baggage of ESG controversies. Investor profile suitability. Who it might be for, this stock could appeal to a very specific type of investor, one with a long-term horizon and a conservative risk appetite, who prioritizes stable dividend income over rapid capital appreciation. Such an investor would also need to believe in the long-term India growth story and in NTPC's ability to successfully execute its massive green transition. Who it might not be for. It is likely less suitable for investors seeking high-growth, agile companies with clean balance sheets and minimal ESG concerns. The low ROE, high debt, sluggish historical growth, and serious environmental and social issues are significant red flags for a growth-oriented or an ESG-conscious portfolio. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.